Yeah, good morning. I think this is our third class of the finance institution management. Um, Earlier, last two classes were taken by Mrs. Fernando, and this class onwards, next few classes will be taken by me. Actually, this class has been structured into the following way. It has been divided into three sections. There are several topics in the uh, in this subject, and the first few topics will be covered by Mrs. Fernando. I think she has covered the first two sections, and now onwards I will cover the another sections. If you see these our presentation, um, I will cover. If you go to the presentations and yeah, how to move the presentation?
Full screen, sir. Slide slow. You will get the full presentation.
Yeah, this is the presentation.
This is for board. If you are using
Board.
presentations, a slide from the beginning.
Yeah. Now you can view my presentation. No. So in these sections, we are covering these. We are covering. If you see these topics of this subject, there are several topics. First started with the incorporations, and then the second one is licensing of finance institutions and shareholders, and group and organization structure and expansion strategies, financial reporting and analysis, and audit. And then following by the audit, the compliance and corporate governance, as well as corporate strategic planning, financial frauds and risk management, and liquidation. These are the topics covered in this presentation, in this subject. And out of these topics, I will cover this red color one, the compliance and corporate governance functions and risk management functions. Of course, if you all see that the syllabus has mentioned the compliance and corporate governance and risk management order, but I am going to follow some reverse side. So I will first cover the risk management area, then I will continue with the compliance, and the final section will be the corporate governance of my topics. And if you see the risk management, we can basically we can start with the question that what is risk, because risk management is one of the important aspect these days in the finance institution management, say banks and financial institutions. And if we first start about the questions that what is the risk, we can identify it is in a very simple way. If anything we are expected to finish or to achieve some our desired point, and if we could not achieve that desired point, then that will be the risk for the any persons or any that activity. For example, we are usually using an example, early morning when we are started to go to the office. We plan that okay, within half an hour period we can reach the office, and then we are starting with 7:30 to and having a plan that okay, we will reach the office by 8 o'clock. But sometimes we could not achieve that desired outcome because there may be accident in the vehicle, and there may be some breakdown in the vehicle. So those things can be categorized as a risk in that event. So likewise, in other way, if I say the some other example, simple example, you all are investing or you all are putting some money into the banks or any finance companies or any equity market with the expectation that okay, the next year or within 1 year period I will reach the, I will earn the 10% profit from that investments. But sometimes due to some reasons you may not able to achieve that 10% outcome, and sometimes you may achieve only 5% outcome, or sometimes you may lose the capital from that investment. Those incidents can be categorized uh, as a risk of that outcome or risk of that investment. So having that simple understanding about the risk, we can define in a way, more systematic way, or for the exam purpose, we can define what is the risk, the effect of future uncertainty on achieving desired outcome can be defined as a risk. This is a general definition for the risk. So we are having a desired outcome, and we are then any future uncertainty may prevent us to achieve the desired outcome. Then that will be called as a risk. For example, in the if we take that our early example, our desired outcome is earning 10% of the return from that particular investment. But due to some reason, sometimes a failure of the finance company, or sometimes if it is the equity investment, the equity market crashes, or the equity market going to the downward trend. Due to that reasons, we could not achieve the 10% return as expected at the time of initial investment. So that's what this definition says, that the effect of future uncertainty on achieving desired outcome would be the we can define that as a risk. Then if we move into the further detailed manner, we can say that difference between the investment's actual return from the expected return is called as a risk. But in this point, actually, we have to have an idea, or we have to have an understanding that we can't just saying that okay, this is a sort of this is sort of if we say okay, we are saying that there is no the between the difference between the investment actual return from the expected return is called as a risk. For example, that return can be in the two way. The first way, it can be in the positive way as well. For example, we are investing amount of money. For example, we are investing 100 million in an equity market or bond market with the expectation that we will get 10% return from that investments. But after some time, due to some reasons, we may lose some investment amount, or we may get only 5% return. That is one way. Or other way, if the prices are going up in as unexpected way, we may get the 15% as a return. So in that circumstances also, the investment's actual returns are different from the expected return. But if it is a positive way or positive circumstances, we will not consider that as a risk. If it is only the negative way only, we consider those those return, the unexpected event, as a risk. So the normally risk are connected to the negative return or negative outcome can be considered as a risk. So if you see that, then we can just say that risk include the possibility of losing some or all of the original investments. So in an investment, the risk could be in a two way. First one is we may lose some of our original investments. That is the worst case scenario. And on top of that, sometimes our original amount may be safe, but we may lose or we could not achieve expected return. As I mentioned, 10% is our expected return, but we may not achieve that expected return of 10%. Then that will be the risk. So now you all may understand that what is the risk and how to achieve the how to define the risk. And if you see that uh, then we can just what are the characteristics of the next question is, now we have identified that, we have discussed that what is risk, and the next question would be what are the characteristics of the risk. And what are the characteristics of the risk also can be, as I already I have explained to you all, there should be an uncertainty. The characteristics of the risk is, the risk should be uncertainty. For example, at the time of investing, or if we know that, okay, our return will be not 10%, it will be only 8%, then that is not called as a risk, because we know that at the time of beginning or our desired outcome will, if we already know the desired outcome, then that cannot be considered as a risk. So in the risk, there should be a characteristic that it should be uncertainty and even may or may not happen. In our first example, we can see that we are going to the office. I say that the risk may be there may be an accident in the vehicle. So that event may happen or may not happen. But if we know that, okay, we are going to the office and the vehicle is in the bad condition, definitely there will be a breakdown. Then if we see that, if we know that all, if we know the 100% sure that there will be an breakdown, then actually that is not a risk, because this is, we know that event will happen 100%. But actually the risk is the event should not have there should be an uncertainty portion in that event. Event may happen or may not happen, that should be there. And the second characteristics, that is I have already discussed with you all, the loss, as an event has unwarranted consequences of loss. As I already explained you all, that the difference between the investment in actual return from the expected return is called as a risk. But this actual return and expected return differences may be in the positive way as well. But if it is the positive way, we will not call that as a risk. If it is a negative only, we are calling as a risk. That is what we are saying, that and even as unwarranted consequences of loss should be considered as a characteristics of the risk. So I think we all maybe understand these things. So we will just move into the next section. What is risk management? You all can understand that what is risk management, and then we can just discuss about it. So first we have seen that what is the risk, and then we are seeing that what is the characteristics of the risk, and then now we are moving that what is the risk management. What is risk management? In the financial world, the risk management refers to the practice of identifying potential risk in advance, analyzing and assessing them, taking precautionary steps to mitigate the risk, and continuously monitor on it. This process will call as a risk management process. So generally, in the risk management, there are 4 steps get involved. The first one is identification of risk. The second one is assessment of the risk. Third one is the control of the risk. The fourth one is monitoring the risk. what is identifying the risk? Actually, when we are investing, for example, we are taking a same example again. There is an investment for an equity market investment. Okay, we take that in example of equity market investment. A bank or finance company, they make a investment in the equity market, which is we say, let's we say 10 million amount of investment. In that investment, before making an investment, actually, or before making a decision on the final decision on the investment, generally the investment people should identify what is the risk involved in the in that particular investments. For example, if it is the equity market investment, so okay, there may be the prices may go down. That is one of the risk. If it is the prices are going down, which risk is called as, what is the risk? The market risk. Then there may be some other risk get involved. Sometime that company may collapse. If the company may collapse, then or solvency in the, if the company may collapse, then entire money may not, we may not get the entire money. So that is the default risk may get involved. Another thing is, when we are making that investments, there may be sometimes we may not able to sell that particular equity investment at the time we want the money, or we want the, if we decided to realize that money, sometime we may not get that money. So those type of risk can be called as a liquidity risk. So in that particular investment, there may be some liquidity risk as well, and some operational risk also maybe take place, because when we are investing through a broker, and we are making that fund transfer and accounting and all. So there may be some operational risk and legal risk, strategic risk, environmental risk. There are several risks which may get involved in the in a particular investment. Or we can even we can say this example in a different way. Bank may or bank or finance company may launch a new product. So in the new product, they are going to make an investment, and the new product may have some credit risk, market risk, liquidity risk, as well as operational, legal, and strategic risk, environmental risk, and regulatory risk. So we will see what are these definition of what is credit risk, what is market risk, what is liquidity risk, and what is operational risk. We will see that. So first you will have to identify. So in this way, first, in any investment activity, the people or the investment people first identify, okay, what would be the maximum risk could arise from this particular investment? What is the minimum risk could arise from the this particular investment? Can they identify what is the definite risk to the particular investment? No, they can't say the definite amount of risk in the particular investment, because one of the characteristics of the investment is, it may be as we see there may be the event may happen or not happen. That is one of the characteristics of the investment. We just see that uncertainty. So based on the uncertainty, we can't say the 100%, okay, there will be this much of people in the particular, or there will be this much of investment or risk get involved in the particular investment activity. So they will first identify what are the risks could arise. Oh, okay, because here we have identified in the slides, you can see that we have listed several risks, but out of the several risks, sometimes there may be few risks could arise involved in that particular investment. Some risk could not related to that particular investment. So they have to identify what are the risks. Then once they identify the risk, as a second step, what they have to do is they have to analyze the risk. Okay, the credit, we just if it is an equity investment, we first saying that, okay, the market risk. What is the market risk? If the equity prices are going down, the investor may lose the money. which is called price risk or market risk. And in the market risk, of course, then first they identified there will be a market risk getting involved in the particular investment. Then they have to analyze, okay, if it is the market investment, what would be the total loss from that particular risk item, of what is the consequences from that particular investment. Actually, in the risk, of course, there may be financial losses, or there may be reputational losses, or sometimes there may be objective losses. So they first they have to identify whether this particular risk will give or financial losses or reputational losses to the bank. You can identify how we can define the reputational risk. For example, in some institution, some risk may create a reputational loss to the particular institution. There will not be any financial losses. So they have to identify whether the financial losses how much, and at what is the minimum financial losses, what would be the maximum financial losses, and all sort of things. Then they have to analyze, okay, these financial losses will occur only once, or again and again it will occur, or what would be the end results, and everything they will analyze in the analysis of the risk. That's what we say, that the scope of the risk must be determined. And it is also important to understand the link between the risk and different factors within the organization. At this stage, the likelihood and impact need to be determined. That's what I say in that to you all. You all remember that. I say that, okay, here there are two words we have to familiarize, like likelihood and impact of the risk. So if the risk could arise, first we have to see what is the impact. Impact may be financial losses, or impact may be reputational losses. But the likelihood is something different. Likelihood is what is the possibility of occurring the particular risk. Sometimes we may say that, okay, there may be very less possibility to occur the particular risk to that particular investment. For example, we are investing in a AAA company, very popular company, and if that company is going insolvent, then there will be a very particular or very little chances there. But we are investing in a company which have a negative net worth. In that case circumstances, there's a high chance or high probability to lose the money, or to the particular company may go insolvent situation. So in a risk assessment or risk analysis, first we have to see the impact, then we have to see the likelihood of the particular risk category. Then if we see the identify the risk, and then as a second we analyze the risk, and the third we have to see the control the risk. What is the control the risk? This is one of the most important thing in the risk management process. The control the risk or managing the risk, managing the risk. Actually, the risk management is different from the managing the risk. The risk management contains these four processes: identify the risk, analysis the risk, control the risk, and monitoring the risk. But managing the risk is generally, or control the risk is the mitigate the risk, if possible, eliminate the risk completely. This can be done by introducing system and procedures and implementing appropriate strategies to eliminate or control the risk. But it is meaning. Actually, if you see that every risk can't be eliminated. Some risk we have to adjust with the risk, or some risk we can mitigate the risk. There are three types of treatment for any risk. The first type of treatment is they completely eliminate the particular risk. But it is not always possible. In some cases, we can't completely eliminate the particular risk. For example, we are investing some money into the particular equity, and then can we completely eliminate the risk by just for against the falling of equity prices? No, it is not possible. But what we can do is we can then go to the next one is mitigate the risk. Mitigate the risk in the sense, rather than the mitigate the risk is rather than eliminate, which will reduce the impact of the risk to the particular investments. To mitigate the risk in the financial world, the general technique or idea is we spreaded the investment into the several type of asset classes. For example, okay, if we put every investment in a particular company, if the prices are going down to the particular company's charts, then we will have a risk of losing money. So we can't eliminate that risk completely, because definitely there will be some sort of price up and downs in the equity market. Those who are working in the banks and finance companies, they may understand that there may be some component in the this some component, some risk which cannot be eliminated. So the prices will go up, go down. Sometimes it will go up. So we can't totally ignore that price falling risk from the equity market investment. So what we can do is we can mitigate. How can we mitigate that risk? Is rather than investing in a particular company, we can invest in the several companies, 5 companies or 10 companies. We are investing that money particular. For example, if a company wanted to invest in the equity investment, rather than investing in their entire money into a particular company, they can invest into the some money to the particular company, and some X company and company X, and some money to some fraction of the money into the company Y, some fraction of the money into the company Z. Likewise, they can spread it. Then if one company's price going down and one company prices going up, then the risk will be get mitigated. So we have to see how to mitigate the risk, and so that is one of the risk controlling techniques to mitigate the risk. So first we see that the completely ignore the risk. That is one of the treatment for to control the risk, but it is not possible always. So the next what we are doing is we are mitigating the risk. So to mitigate the risk in case of equity investment, we are seeing that okay, we are just rather than putting into one company, we are dividing that total investment amount into several fractions and invest in several companies. Then that risk will be, price falling risk will be get mitigated. Other one is that is very sort of how can I say, some instances risk cannot be completely eliminated, risk cannot be mitigated, but still we have to do that event, we have to do that activity. Then what we are doing, we accept the risk, but that is also very rare circumstances. So actually the completely eliminated and dealing with the living with the risk is two component, which is very two extremes, and mitigate the risk is always be free for all. But we can just give this example into the current example, coronavirus or COVID-19. Now currently we are experiencing it. Completely eliminate the risk. Is it possible to completely eliminate the risk? Because it is very unlikely that if you want to go to the office or if market or anywhere, there may be chances to get it that get that disease. or there may be little chances. So we can't completely eliminate. What we can do is we can mitigate the risk. To mitigate the risk, what we can do is we can wear the mask, we can wear the gloves, or we can use the sanitizer, or we can use the wash our hands very frequently. These are the sort of activities we can do to mitigate the risk. So, and we know that, okay, we won't, is going to the hospital is very risky, but sometimes we have to go to the hospital to some other purposes. So accept the risk and go into the hospital. So likewise, there may be three type of treatment in the controlling risk. First one is this, you have to keep in reminder. First one is completely eliminate the risk from that activity. That is very less possibility. Second one is mitigate the risk. So reduce the risk level. That is called mitigate the risk. Other one is the third one is called totally the live with the risk. That is, sometimes if it is that particular activity is strategically very important activity, then the institutions are taking a decision that, okay, live with that particular risk. So these are in the controlling risk part, covering these type of three activities. Then once we finish that controlling risk, we are moving to the last part, monitoring the risk. So first, we are in any investment activity or any finance institution business activity. Before starting that event, we have to go to the risk management process. The risk management process, they have to first identify what is the risk would be involved in the particular activity. The first one. The second one is then analyze the risk. Okay, what is the likelihood from that investment? What is the impact of that investment? Then as a third step, they control the risk. Okay, can we eliminate this? First, they will see that, can we eliminate this completely? No. If it is not eliminated, can we mitigate the risk? Then if it is that, they will go for a mitigation. Or even that is not mitigated, it is not possible to mitigate, but still strategically it is important, they will live with the, or they will carry out that activity with a particular risk. So that is the control. As a final step, they have to move to the monitoring the risk. Monitoring the risk involved, review the risk assessment is important to monitor and improve the control measures. And they find several ways of doing things. Not all risk can be eliminated. Some risks are always present. Market risk is example for the risk that is always need to be monitored. What they are saying, okay, at the time of investment, as per the risk management process theories and practices, they assess they identify what are the risks could be involved in the particular investment activity, and then what they are doing is they analyze the risk and identify what are the risks could be arise in that particular what are the impact and likelihood of the risk activity. Then they control the risk at the beginning. Would enough for the investment? No, because if that the investment may be a 5 years investment. During the down the line, after 6 months, these risk identifications may get different, or risk analysis, the size or impact of the risk may be different from the initial point. Initially, we said, okay, economy are very well, economic conditions are very well, and everything is going smooth. So if we invest in the equity market, there will be upward pressure, upward trend on the equity prices. So prices will go up. So we can earn the profit. And sometimes there may be somewhat some prices, some particular share prices may go down. So we can get only we can get a 10% return, or we can calculate some analysis. But due to some unavoidable circumstances, for example, COVID-19 spread, pandemic spread all over the world, then what will happen? Okay, the things or situation would change from the initial point. So what we have to do is we have to continuously monitor, we have to see that whether the particular investment is getting any changes, significant changes, and any new risk getting involved in the particular investments, and if there is any new, and then what would be the impact and under the new condition, and what are the controlling mechanism we can take to the new condition. Likewise, we have to continuously monitor the risk assessment or risk management, or the particular, these three steps has to be again and again has to be repeated. If you see that this chart, you can identify you can see this diagram, or here it is a continuous process. The identification, assessment, control, monitoring. Again, identification, assessment, control, monitoring. Likewise, this risk management process is this continuous process of these four activities again and again. That is called risk management process. I think you will have understand the risk management process in these discussions. So let's we move to the various risk classifications. Yeah. Now we can move to the next area, which is called okay. Now what we can do, we can move to the next area, that various risk classifications. In the earlier slides or risk management process, we have seen that there may be in an investment activity, there may be several risks could get involved. The financial risk and the several risks could be get involved, and we see that okay, if they invest in the equity market, or banks and finance companies started a new activity, they can identify first. They can identify several risk, and those risks are credit risk, market risk, liquidity risk, operational risk, legal risk, reputational risk, and regulatory risk and strategic risk. We have seen those things. Now what we are going to do is we are going to classify the risk. We can mainly classify the risk into financial risk and non-financial risk. So the next question would be, obviously, what is financial risk and what is non-financial risk? Actually, it is very easy to classify the or define the financial risk. The financial risk is the risk which have an impact on the company's balance sheet. A direct impact on company's balance sheet is called as a financial risk. See that financial risk is a risk that affect the balance sheet of the company. This risk is the danger or possibility that shareholders, investors, and other financial stakeholders will lose the money. So that is called as a financial risk. We are classifying the three risks can be categorized as a financial risk: credit risk, market risk, and liquidity risk. Okay. Now you may understand. You will have to understand what is financial risk. We say that the financial risk is a risk that affect the balance sheet of the company. Okay. How can it affect the balance sheet of the company? For example, a bank granting the loans and advances to a particular company. Okay, then credit risk could arise from that. There are, what is the high risk into the particular loans and advances, granting loans and advances? The credit risk or default risk. If the person default that money, or they fail to, or the customer fail to meet the obligations, what will happen? definitely the company will lose the money. So they grant, for example, they grant the 5 million rupee to the customer A, and customer A default the risk, default that money, and they have the customer A failed to meet the obligation, or failed to meet the obligation of repaying the money. Then what will happen? Company will simply lose the entire 5 million, as well as the interest related to the 5 million. So that particular risk the directly affect the balance sheet of the particular bank or finance companies. This is called as a financial risk, or generally this is as a credit risk. This credit risk also categorized as a financial risk. So the financial risk is a risk that affect the balance sheet of the company, and this risk is the possibility that shareholders or investors or other financial stakeholders will lose the money. The second example we can see that for the equity investment, for a market risk. Okay, a company invest in the bonds. We are, rather than taking always taking the equity investment, we are taking another example, the bond investments. So they are expecting that they are investing at a interest rate of 6% or 7%, 1 year treasury bills. Suddenly interest rates going up. Then what will happen to the investment? If they have to market, then there's a negative relationship between the interest rate and the fair value or market value of the particular investment. Then if the market interest rates are going up, that market value of the particular treasury bill investment or bond investment will go down. Then that will impact the balance sheet of the particular customer. So that market risk also one of the risk that will have, that is considered as a financial risk, and that will have an impact on the balance sheet of the banks and finance companies directly. And same wise, the liquidity risk also is considered as a financial risk. Oh, so we just first define that financial risk is the risk that affect the balance sheet of the company, and this is a danger or possibility that shareholders, investors, or other finance stakeholders will lose the money. This is the definition. So what are the characteristics of the financial risk? First one is, it is generally related to the likelihood of losing money. This is a general characteristic. At any risk, it will have a negative impact. But in the financial risk, the first characteristics is it will have a likelihood of losing money. They will lose the money. That is one first characteristic of generally related to the likelihood of losing money. That is first characteristic of financial risk. The second one is the financial risk most commonly referred to is a possibility that a company's cash flow will prove inadequate to meet its obligations. For example, we can see that our early example, in that example, what happened is, okay, the bank or finance company granted 5 million, say, we will change the example in this way. The bank accepted a 5 million deposit from the customer X, and that from that 5 million, the particular finance company or bank again grant the loans and advances to customer A. So if from the customer, bank has the asset from the loans and the granted loans and advances to customer A, but same time the bank has a liability to the customer X. The bank has to pay 5 million to customer X. So what will happen is, I say that there's a credit risk get involved in the loans and advances activity, and customer A failed to repay the money. Then there's a default risk occurred. So once default risk occur, then what will happen is that will affect the company's cash flow or bank's cash flow, because the banks expect that, okay, I will accept the deposit from the customer X and getting the money and grant the loans to customer A. That is the banking business law. They're granting the loans to the customer A and getting the once the customer A repay, I can repay to the customer X depositor. So if the customer A default, then there will not be cash flow from customer A to the bank. Then what will happen to the particular bank? Because a particular bank may not able to meet the customer X obligations or to repay the customer X. So there will be a cash flow problem will arise to the particular company or banks. That's what he's saying, that financial risk most commonly referred to is as a possibility that a company's cash flow will prove inadequate to meet its obligations. That is the second characteristics of the financial risk. And third one is we are saying the credit risk, liquidity risk, asset-backed risk, foreign investment risk, equity risk, and currency risk are all common form of financial risk. Here I have said that the financial risk can be considered as three risks can be considered as a financial risk: credit risk, market risk, and liquidity risk. Here, of course, credit risk and liquidity risk they have mentioned, and market risk they have divided into several risks: asset-backed risk and foreign investment risk, equity risk, currency risk, which is sort of equity and currency risk are sort of market risk. All these risks could be considered as a financial risk. So we can see that so first in the first slide we have seen that the risk can be categorized into the financial risk and non-financial risk. And the financial risk, we have seen the definition of the financial risk and characteristics of the financial risk, and we have seen that okay, what are the risks get involved in the or can be classified as a financial risk. Now we can move into the non-financial risk. What is non-financial risk? Just think about it. What is non-financial risk?
The legal risk without any.
Yeah, legal risk could be considered as a non-financial risk. We can simply say that these four risks, the three risks, credit risk, market risk, and liquidity risk can be considered as a financial risk. Other than these three risks, all other risks can be considered as a non-financial risk. Here we can see the definition that this risk is danger or possibility that can be arise due to the lack of system and procedures and complaint failures, misconduct technology, or operational challenges, and much more can be considered as a non-financial risk. Normally, the non-financial risk can be this operational risk are conventionally these operational risk are considered as a non-financial risk. So the non-financial risk could arise due to the lack of system and procedures. You can see that in the day-to-day the bank activities or bank operations or finance companies operations, we see that there are several internal control systems are in place to ensure that the system and procedures are works in a proper manner. So if there is a lack of system and procedure and compliance failure and misconduct and technology and operational challenges can be considered as a operational risk, and operational risk is one of the non-financial risk. Actually, the non-financial risk, not only the operation risk, but that is the main part of the non-financial risk, operational, but legal risk also, as you all mentioned, legal risk also one of the non-financial risk. Strategic risk can be the one of the non-financial risk. Environmental risk can be one of the financial risk. There are several non-financial risks we can identify. Actually, in the banking and non-bank finance businesses earlier, they all the risk management mainly focus on the financial risk side. This non-financial risk got very minimum attention of focus. But these days, improvement of technology and IT and all, this non-financial risk become more prominent to the risk management functions, particularly operational risk as well as IT risk, especially this COVID situation. Everything is online. So recently I read an article. It's mentioned that the managing IT risk is very challenging at the time of COVID, because all the functions are happening through the several packages or online or remote basis. Then there's a possibility of hacking the informations and information leakages and all. So the non-financial risk is managing non-financial risk become the challenging for the banking and finance institution. So that is what we are saying, that operational risk. And the second point is, we can say that historically bank has always had to manage financial risk, particularly credit risk and market risk. However, nowadays bank has also have to deal with non-financial. That's what I have already discussed with you all. And operational risk, legal risk, strategic risk, reputation risk, and regulatory risk are some of the non-financial risks. So actually, one by one, we will look into this risk: operational risk, legal risk, and strategic risk. Operational risk, of course, you will understand, and legal risk. Strategic risk is the risk which is normally a banks or financial institution or any other institution. Strategically, they may have to achieve some goals or targets. If they could not achieve that particular target or goal, then that may create a strategic risk to the particular institution. For example, if a Central Bank of Sri Lanka, strategically they have to control the inflations. If they could not control the inflations, then that may create a strategic risk to the particular institution or central bank. So that is, and the reputation risk also one of the most important risks, because even though reputation risk will not create directly, it will not create direct losses to the banks and financial institution, but indirectly it will have a more impact to the severe impact to the banks and financial institution. For example, failure of finance companies will create a reputation risk to the particular industry itself. Then that will create a risk to the finance companies to mobilize the deposits, and that may create other risk through this reputation risk. For example, they may not able to get more fund from the interbank markets or financial markets. So those type of other risk could be created through the reputation risk. So reputation risk also considered as a one of the non-financial risk. And regulatory risk, which is always you will understand that if a banks and finance companies are regulated by the central bank, and if they don't come, and they time to time they are coming up with several regulatory requirement, if the banks and finance companies could not meet that regulatory requirement, then the regulatory risk may arise to the banks and particular banks and finance companies. That is also considered as a one of the non-financial risks. So we have now we have see first we have started in the classification. Now we have finished the first to the broader classification, what is financial risk. Then we have seen that what is non-financial risk, and I think in the next slides we will go into the more detailed manner what is the each category of risk. We will discuss for each category of risk, and we'll see the characteristics of each category of risk. So first, let me start with the credit risk. So far, you all have any questions or anything to ask from me? Okay. I think you all can. If you all want anything to ask from me, you all can feel free to ask any sort of questions related to this topic, and we can move into the credit risk. Credit risk is one of the important risk in the bank and finance business. Uh, Generally, there are if we see the banks and financial institutions, banks and finance companies balance it, the more than 80% of the risk are, or more than 75% of the risk are involved with the credit risk, because credit risk are mostly represented or arise from the loans and advances. If any conventional banking business, the loans and advances are highly represented in the balance sheet of the banks and finance companies. So credit risk is considered as one of the main risk in the banking business. And we can see that credit risk is the possibility of loss resulting from a borrower's failure to repay a loan or meet contractual obligations. Here we can see that a bank or finance company which grant loans and advances to a particular customer A. If the customer A could not repay that money to again to the bank, then in that circumstances, credit risk is arising, which is called as a default risk. Generally, credit risk has two components. First one is default risk, other one is concentration risk. Generally, most of the people think that credit risk is the default risk, but even through the concentration risk, the credit risk could arise. When you are, if I ask the questions, only credit risk could arise from the loans and advances, or can it be, is there any credit risk involved in the investments? Yeah, actually, there will be a credit risk even at the investment also. We may face the credit risk. For example, we are investing in the debentures, and if the company or the company which issued the debentures to other people, if they default that amount, default that capital repayment or interest repayment, that may create a credit risk to the particular in relation to the particular investments. So credit risk is the possibility of a loss resulting from the borrower's failure to repay the loans and loans or meet the contractual obligations. Traditionally, it refers to the risk that a lender may not receive the own principal or interest, which results in an interruption of cash flows and increase the cost for collections. You all must understand that if the customer default to repay or failure to honor their repayment obligations, then bank has to file the case and litigation process and all. This will increase the cost for collection to the banks. So generally, the bank in the banking business, credit risk is one of the most risk get involved. Although it is possible to know exactly who will default on the obligations, probably assessing and managing credit risk can lessen the severity of losses. So I think in the credit risk, as I mentioned already, credit risk is involved the default risk and concentration risk. So far, we have seen all these failure to meet the obligations, repayment obligation, and everything is mainly get involved with the default risk. So there may be a question that what is the concentration risk? What is the connection with the concentration risk with the credit risk? For example, if a bank create their entire portfolio into a particular sector, that will create a concentration risk to the particular bank. For example, we are taking a two bank, Bank A and Bank B. The Bank A grant their loans and advances to the customers in the several sectors. For example, some customers are production industry, some customers are tourist industry, some customers are agriculture industry, some customers are consumers. Likewise, they are granting loans and advances to several industries. That is the Bank A. We are taking an example. And other bank, the Bank B, which grant most of the loans to the tourism industry people. Since it's a simply we can understand, so we just take that example. The tourism industry people. Then what will happen? The Bank B will have a more credit risk due to their concentration of their loans and advances to the tourism industry. Because if since due to this current situation, tourism industry highly affected, and the companies could not have, or they could not earn any revenues during this period. So compared to other industries, the tourism industry affected highly. So if the bank be granted their entire loans and advances to the customers in the tourism industry, they will have the problem, or they will have the high credit risk. But in the Bank A, of course, they granted loans, some are to tourism, some are to agriculture, some are to business and trade, some are to manufacturing, and some are to consumption. Likewise, since they have granted, even though tourism industry get affected, and other industries, some of the industry may less affected, and those people will repay the money to the banks, then they will have less losses compared to Bank B. So the concentration risk also create a credit risk to the banking industry. So that's why even an analysis, generally when we are auditors or the central bankers are examining the bank balance sheet, we examine two things. What is the condition of the customers, whether it is good customers that rated good high rated customers and AAA rated or AA rated customers. And then the second things we are seeing that whether there's a concentration into particular sector or particular customer. Actually, there are several directions issued by the Central Bank of Sri Lanka to prevent this concentration, particularly not the sectors, for the customers. There are directions. Actually, this concentration not only to the sectors, even to the customers also it can happen. For example, Bank A and Bank B, again we can take the Bank X and Y. Bank X grant their loans and advances to 1,000 customers, but Bank B granted only to 10 customers to their entire loans and advances, which will have the high credit risk. Obviously, Bank B will have the high credit risk because they have only 10 customers, and if something happened to the 2 or 3 customers or 5 customers, then that will have a huge impact to the Bank B's balance sheet. But if it is 1,000 customers, okay, some customers will get affected and some other customers paying will, then this bank can manage or mitigate the risk arise from the credit risk. So this is the understanding you will have to have about the credit risk. You will have any questions to ask for me? Okay, I move to the other one, the market risk. Market risk is a risk. Generally, next to the credit risk is the main risk to the banks and financial business. But market risk also one of the financial risk, which is also considered as a one of the important risk in the banking business. Generally, which is involved with the interest rate fluctuations or price fluctuations of the equity prices. We can see as a formal definition, market risk is the risk that the value of the investment will decrease due to the changes in the market factors. That is called market risk. This is a sort of a formal definition. We can see that market risk is a risk that the value of the investment will decrease due to the changes in market factor. This value of the investment can be changed mainly due to the two factors, market factors. One is interest rate, other one is prices of the market prices of the particular instrument. What is the interest rate? There may be two type of investment. One is bond investment, other one is equity investment. In the bond investment, of course, interest rate will have the impact to the impact in the market. So market prices of the particular investment. What is the relationship? I have already mentioned to you all. There are reverse this negative relationship between the interest rate and market value of the particular investment. If the interest rates are going down, the particular investment's market value will go up. And if the market interest rates are going up, the investment value will go down. So if there is any changes or due to the changes in the market factors, interest rates, or some policy decision, if the interest rates are going up, that will have an impact on the investment value, market value of the investment. And due to the changes in the market value of the investment, that will have the impact on the balance sheet of the banks and finance companies. So these type of risk are called as a market risk. And the second one, we are saying that these factors will have an impact on overall performance of the financial markets and can only be reduced by diversification into assets that are not collateral with the not correlated with the market, such as certain alternative asset classes. So this saying that overall performance of the financial market, actually the market, but it defined that what is the market factors. This is about the overall performance of the financial market, and it can be reduced by diversification. Actually, in order to mitigate the market risk, the simple idea is mitigation idea is diversification. Rather than investing into the particular asset class, we have to diversify that particular investment. As I mentioned already, rather than investing entire money into the one particular company's shares, what we can do is we can invest something in the equity market, something into some fraction of money into the government bond market, some fraction of money into the debenture market and money market, reverse repo market. Likewise, we can diversify the investment. By diversification, we can mitigate the market risk arise from any particular investment. Because why diversification will reduce? Because if it is the interest rates are going up or down, that will create the a risk to the bond market only. But if it will not affect the equity market. So if they divert the money into the equity market, okay, equity market may perform well, and this bond market may get affected. Similarly, if bond market prices are having decreasing trend, then the interest rate, due to the interest rate changes, bond market may perform well. So at that time, equity market losses may cover by the bond market performance. So actually, diversification is one of the simple mechanism they can or companies and banks and companies can follow, or any investment manager can follow to mitigate the market risk. The third one is market risk is something called systemic risk, because it related to the facts such as recession that impact the entire market. Actually, market risk is not arising to a particular person. For example, if the credit risk we have seen the credit risk. Okay, if they grant the loans to customer A and customer A fail to meet the obligations, then that is a problem of particular customer A. That is not a systemic issue. But the market risk is sort of systematic risk, because it related to the factor to the entire market. If it is a interest rates are going up or down, that will have a that is a factor that will have an impact on entire market. And price equity prices again, that will have an impact on entire market. So that is sort of systematic risk. It is called as a systematic risk. And market risk include interest rate risk, equity risk, currency risk, inflation risk, and commodity risk. So as I mentioned already, we can consider the interest rate risk. You can understand, you'll know that what is how the market risk could arise from the interest rate risk, because the interest rate fluctuations will change the market value of the investments. So that will create resulted to the lead to a market risk. Equity price risk, that is also we know that the decreasing or the fluctuation in equity prices will create a equity risk to the investment, especially at the when the equity prices are decreasing or market is going to the downward trend. At that time, that may create a equity risk to the equity risk, and that is considered as a one of the market risk. So currency risk also, obviously you will understand that exchange rate fluctuations may create a currency risk to the country and or particular investments. Then that will create a that is also considered as a market risk. For example, if a foreign investor invests in the rupee denominated treasury bonds, and that currency is Sri Lankan rupee is getting depreciated and again by huge amount, then the foreign investor will lose the money, even though it has earned the interest income. Due to the currency risk, exchange rate risk, they may lose the value. For example, at the time of 150 rupees, if they invest in the treasury bonds, then if they again convert it to the dollar at a rate of 180 rupees or 200 rupees, then he will lose the value of the investments. So that is called as a currency risk, and currency risk create a market is also considered as one of the market risk. And inflation risk, of course, you all know that the going up prices and all, that is also considered as a market risk. And commodity risk, of course, we know that the price changes in the commodity will have a risk to the investments, and that is also considered as a market risk. So first, as a we have seen about the market risk. As a next, we can move into the liquidity risk. Actually, there are several questions in the exam papers about the liquidity risk, which is one of the important areas you have to focus on it. Even in the banks and finance business, liquidity risk is one of the major risk which bank has to manage. Before 2008 and 9, this great financial crisis, banks and finance companies, even though they pay attention on the liquidity risk management, it became more prominent after this global financial crisis, 2008 and 9. Legal risk is the risk of financial or reputational loss that can result from lack of awareness or misunderstanding or restless indifferences to law and regulations applied to business, its relationship, process, product, and services. Actually, when you are considering the other institution, when you are compared to other institutions, banks and financial institution having highly legal risk. In every bank, there's a complaints officer and there's a complaints department separately. They are mainly looking to the legal risk of the or compliance risk of the institutions. And when there are several legal, if it is a banking business, which is what act prevailing to regulate the banking business? Number 30 of 1988, the Banking Business Act will have stipulate several conditions on the banking business activities. Even when they accept the deposit, they can accept based on the act. So if they violate those act, then that will create a legal risk to the banks and financial institutions. That's why we are saying that presently it is considered as a part of the operational risk. Okay, this is one of the other aspect. Actually, in the countries, this legal risk also considered as a part of the operational risk, because they are saying that it is one of the system and process and people due to the people failures it is occurring. And then one of the primary reasons why legal risk is associated with operation risk involve fraud, since it is recognized as a most significant category of operation risk event and considered to be a legal issue as well. So that is about the legal risk. And we can move into the reputational risk. Actually, reputational risk is I have explained you all that there can be two type of losses could arise to the banks and financial institutions due to any risk. One risk, what is the one losses? The financial losses. The second one is reputational losses. But here we are seeing that this reputation as a one of the risk category also. This is one of the area, again, ambiguity in the risk management, because reputational risk can be considered as a one of the loss, as well as it is considered as a one of the risk category in the risk management process. It first it says that reputational risk refers to the potential for negative publicity, public perception, or uncontrollable event to have an adverse impact on the company's reputation, thereby affecting its revenue. For example, the banking business and other finance company business, the reputation is one of the most important things we have to manage well. If the banks or finance company, they lost their reputation, it will affect their institution as well as system as a whole. It will have a repercussions. For example, in the recent events, you all may know that in Sri Lanka, these finance companies having some problem in managing the having some finance companies having the problem, and then the regulator Central Bank of Sri Lanka taking actions. Then due to that actions, the people are having the public perception on the finance companies getting worse. That create a impact to the finance company sector as a whole, and that may affect their revenue. So in the banking business and finance companies business, this reputational risk is one of the most important risks which has to be managed by the banks and finance companies. There are numerous reasons for a reputation risk, including outside adverse events, workplace practices, data retention failures, product recall, and bad financial statements will create a reputational risk to the banks and financial institutions. Not only banks and financial institutions, for the other companies and institutions as well. And a negative corporate reputation harm the client and investors' trust, erode your customer base, and hinders sales. A poor reputation also correlate with increased cost for hiring and retention, which decrease operating margins and prevents higher returns. Actually, uh, one of the other consequences of the reputation risk, if the institution fail to maintain their reputation, there will be a high employee turnovers. The employee turnover will be high in the institution where their reputation has an issue. So to maintain that also, there may be not only that, there may be several other issues. Their operational cost will be go up. Then there will be it will affect their margin and it will lead to the financial losses to the institutions. Then next one, we can see that regulatory risk. It is also related to somewhat connected to the legal risk. And regulator in the banks and finance business, there are regulators and there are high regulations. And these banks and finance companies has to meet their regulations. They have to meet their regulations, and in the regulator, if they fail to meet the regulation, that will create a regulatory risk to the banks and financial institutions. Regulatory risk is a risk of change in regulations and law that might affect the industry or business. Such changes in the regulations can make significant changes in the framework of the industry, changes in the cost structure as well. For example, I can say that if the banking industry regulator, Central Bank of Sri Lanka, saying that they are changing their regulation. Okay, minimum capital requirement of the banks will be increased by from this level to other level. For example, from 10 billion to 20 billion within next 2 years period. What will happen to the business? Actually, it is a risk to the particular institution because they have to raise the additional capital to survive the regulatory requirement, to meet the regulatory requirement. So, but if they, in order to raise their capital, they have to make more effort. It will change the structure of the cost structure of the banking business. It may change the framework of the industry because the raising capital will have a more consequences to the particular bank and industry as a whole. So in that case, actually the regulatory risk is also one of the most important risks as that has to be managed by the banks and financial institutions. And second point, we are saying that financial institutions face regulatory risk with respect to capital requirement. That's what I have already explained you. NPL classification, liquidity requirement, services and product, they are allowed to engage in the implementation of accounting standards. Actually, if the now the banks wanted, sometimes back the banks wanted to move from the other accounting standard to IFRS 9. The accounting body wanted to adhere the IFRS 9 within the banking business and their finance institutions, financial reporting. So that will create a risk to the particular banks and financial institution. So that is, all these risks are considered as a regulatory risk that is important for the banks. And next one is strategic risk. And strategic risk, if the banks and financial institutions fail to make a business decisions or lack of thereof, may pose the strategic risk to the banks. We are saying the strategic risk is the risk that failed business decision or lack thereof may pose a company. Strategic risk is often major factor to determine a company's worth, particularly observable if the company experiences a sharp decline in the short period of time. Due to this and its influence on the compliance risk, it is a leading factor in a modern risk management. Actually, this is becoming one of the leading risk factor in the financial business. Then the impact of risk on the institution. Actually, now we have we are going to end the class now. So we will summarize that. First, we have seen that what is the risk, and then we have seen that what is the risk management, and there are 4 factors in the risk management we have seen. What is that 4 factors? There are identify the risk, analyze the risk, control the risk, and mitigate, continuously monitoring the risk. Then we have seen the 4 type of the risk management process. Then we have moved into the different type of risk, and the different type of risk we have in the risk we have categorized into 2. First is financial risk, other one is non-financial risk. In the financial risk, we have discussed about we have categorized into 3 risks mainly: credit risk, market risk, and liquidity risk. In the non-financial risk, then we move to the non-financial risk. Non-financial risk, we have seen several things which we just we have seen several things, and those things which we are discuss about the operational risk, legal risk, as well as strategic risk and regulatory risk, and so on. So now we are moving to so with that we are going to stop this class today, and we will see the other rest of the section in the risk management in the next class. Thank you so much. If